Hello, I'm Lucian Cook, a Director in the Residential Research Department of Savills, and I'm going to talk to you about our latest residential property focus, which looks at the distribution of housing wealth in the UK and what this means for specific markets, such as downsizers, those contemplating a move into the commuter zone, and property investors. We used to talk about the property markets as a single entity, with buyers trading up the property ladder before reaching retirement and trading back down. But the rules have changed somewhat with the credit crunch. Our analysis shows that the market is becoming increasingly polarised, with growing amounts of wealth concentrated in fewer people's hands. At the one end, older homeowners, people who may have bought in the 70s, 80s or even 90s and have now paid off their mortgage, are sitting on substantial amounts of equity. Some £1.7 trillion worth of owner-occupied housing is now completely free of mortgage debt. That's over a third of the total value of UK housing, which is currently worth £5 trillion. In fact, the value of properties owned outright is only marginally lower than the value of mortgaged homes. A small part of this housing wealth, around £3.5 billion a year, is trickling down to new buyers via the bank of mum and dad. But the lower end of the housing market is no longer powered by first-time buyers. Instead, this sector is increasingly driven by investment. Mortgage lenders' demands for larger deposits have effectively prevented a whole generation of would-be first-time buyers from setting foot on the housing ladder. That is forcing people to rent for longer, boosting demand for privately rented homes, and correspondingly providing opportunities for investors. Over the past 10 years, the amount of housing stock in this sector has grown by 61%, and the total value of all private rented properties has risen by a massive 153%. Given that the total value of housing stock rose by 72% over the decade, that's an astonishing rate of growth. The other big split in the market is geographical. The highest amount of mortgage-free, owner-occupied property is not in London, it's in the southeast. However, the highest relative concentrations are in areas popular with the retired or those nearing retirement, such as East Dorset, East Devon, Christchurch, the New Forest and the Malvern Hills. Unlocking this wealth is dependent on the willingness of older homeowners to downsize, as well as demand from growing families wishing to trade up and move out of London. Reluctance by affluent families to move out of the city during the economic downturn, as well as an influx of wealthy foreign buyers, has had a dramatic impact on the concentration of wealth in London. Over the last 5 years, the demand for homes in London has pushed the value of London's housing stock up by £140 billion. Equivalent to the current value of the entire housing stock of the northeast of England. The value of housing stock in London now stands at £1.1 trillion. That means that over 20% of the value of UK housing is in London, the highest share since 2000. So the gap between London and its surrounds has widened. In Zone 2 of London, the average price for a 4-bedroom house is £1.2 million. Whilst in the 20 to 30 minute commuter zone beyond London, it is around £510,000, with further savings the longer the commute. So what happens next? As the economy improves, London homeowners will be tempted to move out of the capital in search of better value for money. However, with few signs suggesting that generation rent will be able to start buying again in volume, demand for privately rented homes is here to stay for the foreseeable future. Our residential property focus gives more detail on all of these topics. I hope you find it of interest.